Thank you all for joining us for today's conference call. We will now start the presentation. Your lines have been muted, so if you have any questions, please email them to admin@mottswealthmanagement.com, or you may ask them at the end of Melissa's comments when we open the line for Q&A. And now, I am happy to introduce you to Melissa Motts. The line is yours, Melissa.
Thank you, Tracy. Hello, everyone. I would first like to thank you all, everyone who's on this call, for your friendship, confidence, your business, and your patience. Please do note that we are recording this call. As a required disclosure, I do need to remind you that the views expressed are those of myself and should not be construed as specific advice. Any questions about your specific situation should be held until a one-on-one meeting or phone call. I also want to thank you for any of your comments or questions. I do want to hear from you so I can respond. That's why we're here. In order to better serve you, we are using this conference call format during which we can provide information in a more timely manner. The call will last until all questions are answered or 1 hour, whichever comes first. Your lines are now all on mute, and then the call will be opened up. Let's see. I have to go over some disclosures. Let's see. I'm a registered representative of, and securities are offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. I'm also an investment advisor representative through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motts Wealth Management and Cambridge are not affiliated. Now for the fun stuff. Market volatility, friend or foe. So, foe is an enemy, something that is out to get you. Friend is your pal, something that is out to help you. With the downward volatility we've been experiencing in the stock market and also in the bond market since August, it can feel like stocks and volatility are our foe, out to show us where we're weak, where we feel like we cannot take the daily decline in our portfolio. If we had someone in our lives that was not cooperating with what we wanted them to do, and it seemed like their behavior was adversely affecting our life, we would question their friendship. And if in a similar way, it feels like we want to distance ourselves from them, and we can feel that way about our stock investments in our portfolio, that we really want to distance ourselves and get away from them because we don't like the way they make us feel. So why should we put up with volatility? What if volatility in stocks is different from that of humans? So consider that interest rates are under 3% right now for high-grade, low-risk bond investments. Consider that we would have to hold a bond for 10 years to get back less than 3% a year. And that also it would be a sure thing of getting back our investment plus the 3% a year. That's what a high grade, like a treasury bond, something like that would be. Any change in the price of the bond wouldn't matter. It would be a moot point because we know we would get our money all back when the bond matures. So just to contrast that, let's take a look at stocks. Are we guaranteed to get our original investment back after 10 years? No. So to reward us for our risk and the inherent volatility, we get a higher rate of return. The average for the S&P 500 companies that make up that index, it's averaged over 5% per year for the last 30 years. Most people need more than a 3% average return to make their money last in retirement. And that's what we're looking at with high-grade bonds. Very, very low risk. Even lower rate than that if we were looking at a bank CD, much lower rate than that. So you just need to understand this, that you cannot get an increased return without the volatility. You have to take volatility to get an increased return. No volatility, no extra pay. So you get paid extra to put up with that discomfort. No extra pay. For most people, no retirement plan that lasts. It may not feel like it, but you are actually getting paid to be patient, to wait, and to feel discomfort. You're actually getting paid extra for the discomfort and for the patience. So my question is, can you make your money last over a long 30-plus years in retirement with rates as low as we are seeing now? For the vast majority of us, the answer is no. So, in that way, be glad for the volatility. You're getting paid extra for it, and you do need the extra pay. So the next topic I wanted to go over was low interest rates. So just to give us some contrast, 10 years ago, slightly over 10 years ago, in June of 2005, U.S. Treasury bonds, so they're guaranteed by the U.S. government, considered the most, safe and lowest risk. So those that were, they mature an average between 11 and 30 years. The average rate of return for bonds issued in June of 2005 was 7.94%. So fast forward that 10 and a half years later. So, and just to clarify that, so on $1 million, if you had $1 million invested, you would get $78,940 per year with virtually no risk for, say, the next 20 years. That's back in June of 2005. So let's contrast that with where we are now, December 2015. And this is after the Fed raised the rates a couple weeks ago. So U.S. Treasury bonds average between 11 and 30 years is 2.73%. On $1 million investment, that would earn $27,300 per year with no risk for the next 20 years. So that's close to a third of what a similar investment paid a little over 10 years ago. And then we have the increase in the Consumer Price Index from 2005 to 2015. It went up 20%. So when we're looking at what we're faced with, we're depending on our investments to give us income in retirement. The interest rates are about a third of what they were 10 years ago, and prices have gone up about 20%. So it's a very challenging environment, and this is what low interest rates are doing. I mean, they're really forcing people to look into, more, take on more risk and so forth to be able to, and to put up with more volatility, to be able to earn that money that they need to so they can have a successful retirement plan. So pension plans. So there are still pension plans around, and they do use an assumed risk-free rate of return, like an interest rate of 7%. They're still using that, and they're calculating how much money companies or governments or unions need to contribute to the plan to make them work for the participants. So if I assumed I would make 7% on my investments, and I'm an employer, well, it keeps my contribution level down. I don't have to put in as much. So if we change the assumed rate of return to 3%, which is closer to what they are now, that gap between those, that is what's causing so much problems in the pension world and causing pension plans to be underfunded. This is why so many employers have opted for cash balance plans that are not dependent on the plan's investment earnings to pay out a fixed amount over someone's life. Instead, the trend, and this will continue, the employer agrees to put X percentage of money into the plan, then whatever you have when it's time for you to retire, you need to make it work. And that's what we're seeing increasingly. And we're going to see more of that because there's just no way that companies can afford to fully fund their pensions if they were to lower the assumed rate of return closer to what it actually is right now. And what this means then in this low interest rate environment, and everywhere I read, it's pretty much a consensus that we're going to be in this low interest rate environment for a long time. So it's really seen as more of a secular trend, which is a long trend, a 20-year trend. It means that people in general should wait longer to retire, should save more, not count on investments to be able to, especially low-risk investments, to be able to provide them with the earnings they need, and then also to spend less. So those are, good things to do in this low interest rate environment. So now I just want to talk a little bit about the value of owning companies. So owning stocks, for the long term. And some people might say, well, gosh, I'm not going to be around that long, I'm retired. Well, most people nowadays, live into their 80s, well into their 80s and 90s, and more people are living to be over 100. So it could very well be, even if you're in your 60s, that you're going to be living for 30 more years, and you're going to need the money to be around for that, to support you as long as you live. So I have some values I just want to compare. Going back to 1985, so that would be the last, 30 years now, 1985. The S&P 500 at the end of 1985, the value that it closed at was 211. And then in 1995, 10 years later, it closed at 615. So the value of the company's stock, the shares for all the companies in the S&P 500 went up, considerably. And then in 2005, the value at the end of December was 1,248. So again, another increase. And then as of November 23rd, 2015, the value was 2,086. So even with bear markets, we've had two pretty good-sized bear markets in 2000 to 2002 and 2008 to 2009. The S&P 500 values of those companies continue to grow. Our gross domestic product, so that would be like the value of our economy in the United States. If it were a company, in 1985 it was $7.71 trillion. In 1995 it was $10.2 trillion. In 2005 it was over 14 trillion. And as of September 30th, 2015, it was 16 trillion. So you can see that our economy in our country continues to grow. It doesn't grow in a straight line. There are ups and downs, but it is expanding and expanding. The S&P earnings per share, so the companies in the S&P 500, if we average out their earnings per share, in 1985, they were $15.68. 1995, up over $37. In 2005, over $76. And right now where we stand, the estimate for the full year would be $118 per share. So here again, we can see companies growing their earnings, values growing. And the dividends, which, we do utilize dividend-paying stocks, they have grown as well. So back in 1985, the average dividend for an S&P 500 company, we take all 500 of them, was $8.20. In 1995, it was $14.17. In 2005, it was $22.38. And the estimate for the end of this year is $43. So when we compare stocks, the value of owning companies versus having companies owe us, which would be bonds or loans, we can see that an expected return on a 20-year U.S. Treasury bond right now versus owning the S&P 500, you would get each year on a $1,000 bond, you would get interest of $27.30. And then you'd get your original $1,000 back in 20 years. So over that time frame, you would have got a total return. You've gotten $546. So you've gotten your plus your $1,000. You get that back. So for the S&P 500 companies, you would get right now you would get $20.04 per year in dividends. And with history as our guide, you could expect that your dividend would increase over time. Some companies in the S&P will reduce dividends, some will go out of business, some will increase dividends. They'll buy each other and merge. Others will be added as new companies we've never even heard of right now. With history as our guide, you could expect that the value of your $1,000 would grow. So, of your original $1,000 investment in the S&P 500. So, total return using just the dividends, without even the $1,000 growing at all, would be probably just about $1,667 for the next 20 years. And if we had a modest increase in value of 1% a year in the value plus the dividends, your total return would be, at least $1,900. And our returns over 20 years have always been higher than 1% a year. So you can see that, it really pays to own companies. They raise prices, they develop new products, etc. And you get paid extra for the volatility. So that's why we do have in your portfolios a mix of investments. So that was everything that I did want to talk about today. So Tracy, are there any questions at all?
I haven't seen any questions come in, Melissa. At this time, we'll open up the line for questions. If you have questions, please unmute your line by pressing *6 and state your first name. We will answer all questions in order. Again, if you have a question, please unmute your line by pressing *6 and state your first name.
Looks like we have a shy group today.
I think so.
Well, great. Well, then I'll just wrap it up. Thanks, Tracy. So thank you thank you everyone for participating in our call. Thank you for your trust in us and your friendship. My wish for you and yours is a healthy, prosperous, and abundant 2016. And for those Star Wars fans, may the Force be with you. Thank you.
Thank you once again for joining us on this conference call today. We will be holding our next conference call on Wednesday, April 27th, 2016. If you have any questions at any time, please feel free to give us a call at 215-513-6240. Again, thank you for participating in today's call, and have a great day.